Right, diving into some really fascinating stuff today, especially for those of us here in the UK who, want to make sure our money is working as hard as it can for us.
Absolutely.
And really, this whole deep dive was actually arranged by
Yeah.
ProTax Accountant, a well-regarded accounting firm here in the UK.
Right.
And they kind of set this up, wanting to make sure that you guys are in the know when it comes to tax-efficient investing in the UK. So,
Yeah, it's such a crucial topic, right?
oh, absolutely.
Because the UK tax system, well, it can be a bit of a maze sometimes, especially when it comes to investments.
Oh, for sure.
So what we're trying to do today is kind of like shine a light on some of the best ways to, keep more of your hard-earned returns, help it all stay here in the UK where it belongs.
Exactly.
And really break it down in a way that's clear,
Yeah.
practical,
Yeah.
So you can actually use this information to make those smart decisions.
Exactly.
And feel confident about your investments.
Yeah. All right. So let's start with something that I think a lot of people have at least heard of.
Oh, yeah.
It's something very fundamental when it comes to investing and saving here in the UK, and that is the individual savings account, better known as the ISA.
The ISA.
Yeah. So most people have heard of it, but I think it's worth really breaking down why it's so powerful and what it actually means for people.
Absolutely, yeah.
So what's like the core benefit of an ISA?
So think of an ISA as like a protective bubble.
Okay.
So all of your savings and your investments
Right.
and any returns that you generate inside this bubble, whether it's, interest that you're earning on cash
Yeah.
or dividends from shares or profits when you sell assets,
Yeah.
all of that is completely shielded, protected
Oh.
from income tax and from capital gains tax.
Okay.
So that's a massive advantage, right?
Huge.
It is, yeah.
Especially when you consider how much we get taxed here in the UK.
Exactly. And the great thing is, for both the 2023-24 and the current 2024-25 tax years,
Yeah.
you've got a very generous allowance,
Yeah.
a 20,000 pound annual allowance
Yeah.
that you can spread across different types of ISAs.
Okay, so 20,000 pounds where the tax man
Tax man can't touch it.
can't touch those returns.
Exactly.
That's a pretty serious incentive.
It is, yeah.
And you mentioned, different types of ISAs.
Right.
It's not just one flavor, is it?
Not at all. No. It's not just a one-size-fits-all.
Yeah.
There are different types that cater to different goals and objectives.
Okay, yeah.
So, for example, you've got the cash ISA, which is
Yeah.
essentially like your tax-free savings account.
Yeah.
Very simple, secure.
Yeah.
Then you've got the stocks and shares ISA, which allows you to invest in a wide range of assets,
Okay.
company shares, funds, and again, any growth or income from that is tax-free.
Right.
Then you've got the lifetime ISA, sometimes called the LISA.
The Lisa, yeah.
This is specifically designed for first-time home buyers or for those saving for retirement.
Right.
And it offers a really nice government bonus on top of the tax benefits.
Wow.
And finally, you've got the Innovative Finance ISA,
Innovative Finance ISA.
or the IFISA, which allows you to dip your toes into things like peer-to-peer lending,
Okay.
where the interest that you earn can be tax-free.
Very cool.
So you've got a whole buffet of ISAs to choose from,
A whole buffet, yeah.
depending on what you're aiming for.
Depending on your goals.
Exactly.
Okay, now I've heard of this thing called the bed and ISA.
A bid in ISA.
Bed and ISA strategy, which sounds very intriguing.
It's quite interesting.
Yeah.
It's kind of like a clever way of using your ISA allowance,
Okay.
even if you've got investments outside of an ISA already.
Right.
So let's say you've got some investments
Yeah.
that are sitting in a regular taxable account.
Right.
The bid in ISA strategy involves selling those investments
Okay.
and then immediately buying back the same investment
Right, in the ISA.
inside your ISA. So essentially, you're moving those assets into that tax-free ISA environment.
That protective bubble.
Exactly.
Okay.
To shield any future growth from the tax man.
Smart.
But there's a crucial point here.
Okay.
When you sell those investments outside the ISA,
Yeah.
if they've gone up in value,
Yeah.
you might trigger a capital gains tax bill.
Oh, okay.
So you've got to weigh up.
So it's a balancing act.
Exactly. It's a bit of a balancing act.
Okay.
Weigh up the potential long-term tax savings
Yeah.
inside the ISA against that potential immediate tax hit.
Gotcha.
So it's often a good thing to consider
Yeah.
if you've got investments that you think are going to grow significantly
Yeah.
and you plan to hold them for a long time.
For a long time. Okay.
Yeah. So you can ride that wave of growth inside the ISA and avoid those taxes in the future.
Okay, so, there might be a little bit of a tax,
Totally. Yeah.
a little hurdle to jump over immediately.
Yeah.
But long term, it could be a real win to get those investments shielded.
It could be, yeah.
Okay, cool. So ISA is definitely foundational.
Yeah, definitely a key part of your tax-efficient toolkit.
Yeah, let's move on to another big one, another big player in this world,
Okay.
and that is pensions.
Pensions, yes.
Pensions. So how do pensions offer tax advantages?
Right. So
How do
pensions,
we differ?
they're very powerful
Okay.
in terms of tax benefits.
Right.
And they're specifically designed to encourage us all to save for retirement,
Yeah. Yeah.
which is a good thing, right?
Yeah.
We all need to think about that.
Yeah.
So the most immediate benefit is the tax relief you get on your contribution.
On the contributions. Okay.
So essentially, you get tax relief at your highest rate of income tax.
So if I'm a basic rate taxpayer,
If you're a basic rate taxpayer, yeah.
could put in
Let's say you put in 80 pounds.
80 pounds.
The government is essentially adding an extra 20
Wow.
to bring that up to 100.
Right.
So it's like an immediate boost.
An immediate boost.
Yeah, and if you're a higher rate taxpayer,
Yeah.
that benefit is even more significant.
Or significant. Okay.
It's a really nice incentive.
And on top of that.
And then, mirroring ISAs,
Yeah.
all of the money that's sitting in your pension pot
Yeah.
is growing free from income tax and capital gains tax.
Wow. So it's like,
It's a double whammy
it's double whammy.
of tax efficiency.
Okay, so you get that relief up front.
You get the relief up front,
and then you get the relief
and you get the relief as it's growing.
as it grows. Yeah.
Exactly.
Okay, what are the main types of pension schemes?
Okay, so the most common ones
Yeah.
that you'll come across are workplace pensions,
Workplace pensions.
where you and your employer both contribute.
Right, right.
And that's automatically benefiting from tax relief.
Right.
And then you've got self-invested personal pensions,
Self-invested personal pensions.
or SIPPs.
Yes, IPPs.
And SIPPs give you a lot more control
Okay.
over where your money's invested.
Yeah.
So if you want to be a bit more hands-on
Right.
and have a wider range of investment options.
More choices?
Exactly.
SIPP it is?
SIPP might be the way to go.
Okay. Okay.
Yeah.
Now, are there limits to how much,
Ah, yes, good question.
I assume there are.
Yeah.
How much you can contribute each year?
Yes, so there are annual allowances
Okay.
for this current tax year.
Yeah.
The standard annual allowance is 60,000 pounds,
Okay, 60,000.
or 100% of your income,
Okay.
whichever is lower.
Whichever's lower. Okay.
Yeah. Now, it's important to note that for higher earners,
Yeah.
and by that we mean people with an adjusted income over 260,000 pounds,
260,000.
that annual allowance can be reduced
Okay.
or
Low
tapered.
tapered. All right.
But there's a really good thing about pension rules,
Okay.
and this is that you can carry forward any unused allowance
Oh, wow.
from the previous 3 tax years.
Okay.
So let's say you didn't use your full allowance last year.
Yeah.
You can roll that over
Oh,
and
wow.
use it this year.
Interesting.
So this is great if, maybe you've had a windfall.
You come into some money.
Exactly.
Yeah.
And you want to make a larger pension contribution.
Gotcha.
You can still benefit from that tax relief.
So pensions are a cornerstone
They are, yeah.
of long-term, tax-efficient
Absolutely.
wealth building for retirement.
Yes, they're a fantastic tool.
Fantastic. Okay, let's move on to something maybe a little bit further off the beaten path,
Okay.
but still offering some pretty great tax advantages, I think.
Right.
I'm thinking about venture capital trusts.
Venture capital trusts or VCT.
And VCTs, yeah.
Yeah.
So what makes them stand out from a tax perspective?
Okay, so VCTs,
Yeah.
they're listed investment companies that specialize in investing in, smaller,
And-
often higher growth potential
Yeah.
UK businesses.
Businesses, right?
And because these types of investments come with, a greater level of risk,
Yeah.
the government actually offers some pretty attractive tax breaks to encourage people to invest in them.
Okay.
So if you invest in a VCT
Oh, yeah.
and you hold those shares for at least 5 years,
5 years. Okay.
you can actually get upfront income tax relief,
Up front. Wow.
up to 30%
30%. Okay.
on investments up to 200,000 pounds
200,000 pounds. Wow.
each tax year.
Okay.
Now, on top of that,
On top of that, yeah.
any dividends that the VCT pays out are tax-free,
Okay.
and any profit you make when you sell your VCT shares
Yeah.
is also exempt from capital gains tax.
Completely exempt. So that's a big deal.
It's a powerful combination of tax advantages.
Yeah, that 30% income tax relief up front.
Yeah, it's pretty hard to ignore.
Pretty hard to ignore, but obviously we're investing in
Right.
smaller, potentially more volatile
Exactly.
businesses. So
So the risk is there.
There must be a significant risk factor.
Yeah, absolutely. You're spot on.
Okay.
VCTs are definitely considered higher risk.
Okay.
So they're not for everyone. They're typically better suited for experienced investors who really understand what risk is and are comfortable with, potentially losing money.
Yeah, totally.
But for those who are willing to take on that risk, the potential for higher returns coupled with those tax benefits can be very appealing.
Can be very appealing. So it's about aligning your risk tolerance
your risk appetite
with the potential rewards and tax advantages.
Absolutely.
Okay, cool. Let's talk about another scheme. Well, actually, a couple of schemes that aim to support smaller enterprises, and that is the Enterprise Investment Scheme, the EIS.
The EIS.
And the Seed Enterprise Investment Scheme, the CIs.
The CS.
So how do these compare to VCTs, and what kind of tax breaks are we talking about here?
Okay, so both EIs and Cs. They have the same goal as VCTs, right?
Right.
They want to channel investment into those smaller, higher risk companies.
Right.
But they do it slightly differently.
Okay.
They target businesses at different stages of their journey, and they offer different levels of relief.
Okay.
So the EIS offers a very generous 30% income tax relief.
30%. Okay.
On investments up to £1 million.
£1 million.
Per tax year.
Per tax year.
And that can actually go up to £2 million.
Wow.
If you're investing in what are called knowledge-intensive companies.
Knowledge-intensive?
Yeah, and then on top of that, income tax relief.
Yeah.
Any gains you make on those EIN shares can be completely free from capital gains tax.
Wow.
As long as you've held them for at least 3 years.
3 years. Okay, so
you're essentially supporting these growth-oriented businesses while getting a really significant tax break.
Significant tax break, yeah.
Exactly.
Okay, and so this is focusing on
even earlier stage.
Even earlier.
Even riskier.
Even riskier, so the tax relief is...
The tax relief is even more generous.
Even more generous, okay.
So with SICE, you can actually get a 50% income tax relief.
50%?
On investments up to £100,000 per tax year.
100,000, okay.
And just like EIS, any gains after 3 years are also free from CGT.
Okay, so
it's a fantastic way to get involved
with
those very young companies.
Yeah, so for those who are really,
if you've got that appetite for risk.
Yeah, big risk, big reward.
Exactly.
Yeah. Okay, cool. So both I's and Si's, really compelling.
Very compelling, yeah.
For those who are comfortable with those risks.
Absolutely.
Okay, now let's pivot to something completely different.
Okay.
I was intrigued to see this on the list.
Forestry.
Yeah. Investing in forestry. Yeah. I had never really thought about this as a tax-efficient option.
It's not the most obvious one, is it?
Yeah, so what are the benefits?
So investing in UK commercial woodlands actually comes with some really unique tax advantages.
Okay.
So any income or profit you make from selling timber is completely free from income tax and capital gains tax.
Okay.
So that's a really big deal, especially over the long term.
Yeah, so for the long term.
Absolutely.
Okay.
And under certain conditions.
Yeah.
And after you've owned the woodland for at least 2 years.
Okay. 2 years.
It can also be exempt from inheritance tax.
Wow. So it's
quite a powerful.
Right, different.
Yeah, it's a bit different than your usual stocks and shares.
Than your typical, But
it's very tax efficient.
Very tax efficient.
And it's got that nice sustainability angle as well.
The environmental angle?
Yeah.
Okay, that's a fascinating option that I had not really considered before.
Yeah, it's definitely worth exploring.
Yeah. Okay, now what about the property market?
Okay.
Because I know a lot of people, they get into buy-to-let properties.
Yeah.
Are there ways to structure that investment in a tax-efficient way?
Yes. So one strategy that some buy-to-let investors use is to hold their properties within a limited company structure.
Okay, a limited company.
Rather than owning them personally.
Okay, and what are the advantages of that?
So this can offer some tax efficiencies, particularly around mortgage interest tax relief.
Yeah.
Which has become more restricted for individual landlords.
Okay.
Additionally, corporation tax rates can sometimes be lower than those higher personal income tax rates.
Okay.
So potentially, you're reducing your overall tax burden.
Gotcha.
But it is a more complex arrangement.
Yeah, it sounds it.
Yeah, it's not a simple, tick-a-box exercise.
Right.
So it's really crucial to get professional advice.
Okay, talk to an expert.
Yeah, make sure it's right for you.
Make sure it's right for you.
For your circumstances.
Okay, we touched on innovative finance ISAs earlier.
Right, the FISA.
The IFISA. Give us a little bit more detail on how those provide tax efficiency.
Right. So the IFISA, allows you to use your ISA allowance.
That 20,000 pounds.
That 20,000, yeah. To invest in things like peer-to-peer lending platforms.
Right.
And other eligible debt-based securities.
Okay.
Now, the main benefit, the tax benefit here, is that any interest you earn on those investments within the IFISA is completely tax-free.
Okay, yeah.
So it's a good option if you want to diversify your ISC a bit beyond the typical cash and stocks and shares that potentially achieve higher returns.
Yeah.
But still with that tax-free status that all ISAs enjoy.
That lovely ISA protective bubble.
Yes.
Okay, cool. Now, let's talk about a couple more, I guess, traditional savings options, premium bonds, and help-to-save accounts.
Right.
How do these kind of fit into the world of tax-efficient saving?
Okay, so premium bonds, they're issued by National Savings and Investments.
Yeah.
And they work a bit differently.
Okay.
They don't pay regular interest. Instead, they enter you into a monthly prize draw.
Oh, okay.
Where you have a chance to win tax-free prizes.
Okay.
So these can be anything from, smaller amounts all the way up to £1 million.
Wow.
You could hold up to 50,000 pounds in premium bonds.
Oh, okay.
Now, the thing is, the overall return is based on luck, right?
Yeah.
So the average return might be lower than some other options out there, but any prize that you win is completely tax-free.
Tax-free.
Yeah, so that can be very appealing, particularly if you
feel lucky.
Exactly, if you let them want a chance.
Right, and the help to save, this is
targeted at lower income individuals.
Okay.
So it's a government-backed savings account.
Okay.
Specifically for people who are receiving universal credit or working tax credit.
Right.
And it allows you to save up to 50 pounds per month.
50 pounds a month?
Yeah. And then after 2 years, you get a 50% bonus.
50
on the highest balance you've achieved.
Okay.
And that bonus is tax-free.
Tax-free. Okay.
And there's a potential for a second bonus.
Wow.
If you keep saving for another 2 years.
Okay, so given those bonuses, it's a very high return option.
It's a very high return option,
For those who qualify?
Absolutely. So if you're eligible,
it's a fantastic scheme.
It's definitely worth looking into.
Okay, now let's step back a little bit from specific investment products and talk about some general principles of capital gains tax planning.
CGT planning.
CGT planning. How do we
minimize those liabilities?
Yeah.
Okay, so capital gains tax, or CGT, it's the tax you pay on profit.
On profit,
from selling certain assets like shares or property.
Yeah.
But it's only payable on gains that exceed the annual exempt amount, which is set to be 3,000 pounds for the 2025-26 tax year.
3,000 pounds. Okay.
So you've got that allowance to play with.
Yeah.
Now, the rates of CGT, they vary a little bit. Depending on your income tax band.
Right.
And the type of asset you're selling.
The type of asset. Okay.
So, for example, the rates for property tend to be a bit higher.
Higher than
for things like shares.
Than for shares. Okay.
Yeah. So one good strategy for managing CGT is to try and spread out your asset sales.
Okay. Spread them out.
Yeah. So you're not crystallizing all of those gains in one go.
Okay.
Because then you can use that annual exempt amount. Each year.
Okay.
And potentially keep more of your profits.
Okay.
Out of the tax net.
All right.
And another important thing to remember. Is if you make a loss. So let's say you sell an asset at a loss. You can actually offset that loss. Against any gains you make.
So losses
will work in your favor.
Yeah.
So it's important to
big track of
be aware of that. Yeah.
Okay, and finally, let's talk about the personal savings allowance and the dividend allowance.
Right.
How do those affect the tax efficiency of our savings and investments?
So these are important allowances to keep in mind.
Okay.
The personal savings allowance
essentially
allows basic rate taxpayers to earn up to 1,000 pounds in savings interest each year.
Okay.
Without paying any tax on it.
All right, so that's like a
free pass.
Free pass for interest.
Exactly.
Yeah.
Now for higher rate taxpayers, it's 500 pounds.
500 pounds.
And additional rate taxpayers unfortunately don't get a personal savings allowance.
Don't get it at all.
No. Okay. So if you've got savings, Keep an eye on those limits.
Keep an eye on them.
Make sure you're not paying more tax than you need to.
Yeah.
And then similar to that, you've got the dividend allowance.
The dividend allowance, okay.
Which, for the 2025-26 tax year, will be £500.
500 pounds, okay.
So that means you can receive up to £500 in dividend income.
Yeah.
Tax-free.
Okay.
And anything above that is taxed at your income tax rate.
At your income tax rate.
Yeah. So
okay.
Understanding these allowances is really crucial.
Yeah, it really is. It's a lot to keep track of.
It is a lot.
But it's so important.
It's so important because it can make a big difference.
Yeah.
To your overall returns.
Yeah. So as we've seen, I mean,
it's been quite a journey.
Yeah, there's a lot
to cover.
Yeah, a lot to cover, but there's a lot of different options.
Absolutely. There's a really comprehensive range of tax-efficient options available here in the UK.
In the UK, yeah. And it's pretty amazing, that the government has put these schemes in place.
Yeah, they've created these incentives.
Yeah, to really,
encourage us to save.
Encourage us to save and invest.
Yeah, and invest in different areas of the economy.
Yeah. So we've got the sort of the mainstays, the ISAs, and the pensions.
Yeah, you're telling me.
Foundations, but then we've got, the more specialized things like VCTs.
The VCTs, the EIS, the even forestry.
Yeah.
And all these different ways to really kind of tailor it.
To tailor your approach.
To what you're trying to achieve.
Absolutely. Yeah. It's not a one size fits all.
But as you've mentioned, throughout this whole deep dive,
right,
the suitability of each of these is going to depend.
It's going to depend on your individual circumstances.
Your specific goals.
Your goals, yeah.
And your risk tolerance. Expert speaker.